Greetings everyone, and thank you for joining today's session. We've come together with a clear focus today, and that is to closely analyze the financial statements of Sunway REIT and also Pavilion REIT. Both are influential names in the industry and could represent significant investment opportunities. However, we are here to look beyond just the names, to delve into the numbers, understand the trends, and gauge their true investment potential. As we go through the details, I encourage an open discussion. Your insights and questions will drive our understanding deeper. Let's work collaboratively to uncover the financial power of these entities.
Is Anissa, and please Anissa.
So firstly, let's delve into the financial performance of Sunway REIT. So comparing its 2022 figures to those 2021, it gives us a clearer picture of its growth, trajectory, and key financial movements. So we witnessed a commendable 43.29% surge in 2022, culminating at 656,301 in sales and revenue. As for operating income, it shows impressive growth by 68.13% this year, showcasing efficient operation. Net income, on the other hand, had a strong bounce back with a 175.12% increase, reflecting robust profitability. Next, EPS rejuvenated performance with about 167% growth in 2022, promising for stakeholders. And last but not least, unusual expense notably reduced in 2022, indicating better financial management. So to summarize, in 2022, for Sunway REIT showcased not only its ability to withstand economic challenges, but also remarkable rebound in crucial financial sectors. This resilience underscores the strength of its management strategies and its adaptability to market fluctuation, proving that the trust is positioned well for the future growth. Secondly, let's take a look at the financial performance of Pavilion REIT. When comparing its figures from 2022 to those of 2021, we can discern some interesting trends and insights. For the sales revenue, they exhibited a growth of 16.82% in 2022, indicating a positive market response. Operating income shows an uptick of 58.08% this year, which suggests effective operational management. Pre-tax income, on the other hand, shows a substantial leap of 217.63% in 2022, which highlights a remarkable financial turnaround. Net income are consistent with pre-tax income, displaying a stellar 217.63% growth this year. And lastly, for EPS, a resurgence we observed was with over 217% growth in 2022, reflecting enhanced shareholder value. So to conclude, in 2022, for Pavilion REIT, they demonstrated a notably turnaround. After grappling with the setbacks of prior years, it displayed a strong resurgence, emphasizing its robust strategies and its capability to adapt and flourish despite past hurdles. That is all for me.
I see. So thank you very much, Anissa, for your comparison for both Sunway and Pavilion. Although both exhibited an amazing growth, however, clearly Sunway has the upper hand with almost 30% difference. So without further ado, please Roshan, please present to us our ratio analysis for both Sunway and Pavilion.
Alright, thank you, Chairman. Like he said before, I'm going to dive into the financial health of Sunway REIT and also Pavilion REIT using ratio analysis. Starting with liquidity ratio, under liquidity ratio there's two other ratio, which is current ratio and also quick ratio. For the current ratio, Sunway REIT has a good ratio of 2.42 and Pavilion REIT shines brighter than that. It's around 2.68. For the quick ratio, Sunway REIT ratio is around 0.16, while Pavilion REIT is way different. It's 0.44, showing a stronger liquidity without relying on its inventory. Now I'm going to jump into the profitability ratios. Profitability ratios comes with gross profit margin, net profit margin, ROA and also ROE. Starting with gross profit margin, Sunway REIT margin is around 68.74% and Pavilion REIT is at 62.78%. While for net profit margin for Sunway, Sunway rate is retained at 51.24%, while for Pavilion rate is at 71, that's a huge jump, 71.70%. While for the ROA, Sunway rate ROA is at 3.44% and Pavilion rate is at 6.14, indicating efficiency asset in utilization. And finally, for the ROE, which is Sunway rate ROE, is at 5.85%, while Pavilion is shockingly at 9.80, showing stronger profitability relative to the equity. So, in conclusion, this ratio gives an insight of their liquidity and profitability in 2022, and I highly suggest for us to go for the Pavilion rate stock.
Alright, so our market research manager, Sarah.
Yes.
So please present about your findings regarding both Sunway and also Pavilion.
Thank you, Chairman. For market research and comparative analysis, property portfolio summary, suburban properties with a mix of commercial and residential and leisure spaces. Unlike Pavilion rate, urban focus on premium commercial venues, upscale malls and luxury residences. For location advantage, Sunway rate suburbs appeal to families seeking spacious environment, while Pavilion rate is urban location attract those who value amenities and city living. Next is economic impact. Sunway rate benefit from suburban shift post-pandemic, while Pavilion rate thriving due to urban revival and infrastructure project. For market position, Sunway rate has dominant in suburban real estate targeting growing towns, while Pavilion rate are stronghold in urban landmarks, notability in Kuala Lumpur. For future prospect, Sunway rate are potential growth with increasing interest in suburban living, while Pavilion rate has a value rise through urban development and infrastructure. In conclusion, I think Sunway rate and Pavilion cater to distinct segment of Malaysian involving property market, capitalizing on suburban allure to and urban dynamism respectively.
Alright, thank you very much, Sarah. So up next is our risk management manager, Sarila. So please present to us our findings regarding both risk in investing in either Sunway or Pavilion.
Good afternoon. So when it comes to investment, understanding and mitigating risk is as essential as evaluating returns. So let's dive into the potential risks for both REITs. So the first one is market volatility. So risk can be affected by economic downturns or global events, influencing property values and rental income. So for the next one is tenant dependability. So rental income is vital for REITs. Changes in the tenant mix or economic struggles of major tenants can impact returns. And for interest rate sensitivity, REITs are sensitive to interest rate changes. Rising rates can escalate borrowing costs and may decrease property values. So for the regulatory changes, unexpected shift in property or financial regulations can affect the profitability of REITs. And for geographical concentration, if a REIT's properties are localized, regional economic or political issues can hinder performance. So in conclusion, while both REITs present promising opportunities, it's our responsibility to continuously monitor and adapt to these risks. Investment decisions should always be made with a holistic view of both the rewards and potential challenges.
So thank you very much, Selina. So again, our investment strategy manager, can you please present to us our findings?
Good day, team. So we are wasting time. So let's dive into our investment strategy. So we are going to take into our recent analysis that we have made. I'm an investment and strategy and decision making. So we'll be talking about two of our company, which is primarily is a real estate investment property, real investment interest trust, which is REIT. There's two companies here, which is Pavilion and Sunway REITs. Our confidence lies in Pavilion REIT since they have a robust financial indicators and performance make them a prime investment candidate. I recommend an aggressive acquisition of their shares and capitalizing on their current strong position for the future. As for the Sunway REIT, while there's a potential, our confidence isn't as high as the Pavilion REIT. So instead of making large sum purchase, I advise a more conservative approach. I suggest adopt an interval method so we can buy the share in a smaller quantities over spaced out intervals. This staggered approach allows us to monitor and minimize the risk and performance and making the adjustment as needed. So in essence, we are going full throttle with Pavilion while being more measured and deliberate with Sunway. We are also going to purchase steadily over time, and I believe this balanced strategy should position us well in both short-term and long-term stability.
Alright, so thank you very much for your findings, Zakir. I think that was very insightful towards our investments. So finally, our portfolio management manager, Dinesh, please present to us what do you think about Sunway and Pavilion.
Alright, thank you. Good day, ladies and gentlemen. So today I would like to discuss the comprehensive portfolio strategy that encompasses two real estate investment trusts, which is Sunway and also Pavilion, into our investment approach. So without wasting any time, let's dig into it. So the net profit margin of Sunway rate is 51.24%, whereas for the gross profit margin, it is 68.74%. If you look into Pavilion rate, the net profit margin is 71.70%, and its liquidity ratios are notably stronger, with an acid test ratio of 0.44 and a current ratio of 2.68%. So by integrating both Sunway and also Pavilion rate into our comprehensive portfolio strategy can offer a balanced approach. By carefully weighting their allocation, we can leverage Sunway's rate's strong profitability and also Pavilion's robust liquidity, ultimately enhancing portfolio's potential for stable income and also capital appreciation. In conclusion, Sunway and Pavilion rate each bring unique strengths to the table, where Sunway with its profitability and also Pavilion with its liquidity. So by integrating these rates into our portfolio, we can aim to achieve a harmonious blend into income generation, capital growth and also risk management. It is also important to continuously monitor market trends at the same time too. So that is all from me. Thank you for your attention.
Alright, so thank you very much, team, for coming to this meeting and for presenting your evaluations. So after hearing everyone's thoughts about this, my recommendation is towards Pavilion simply because, first of all, the profitability. Pavilion's net profit margin is a striking 71.70%, well above Sunway rates 51.34%. For liquidity, with a current ratio of 2.68, Pavilion rate is a better poised to meet short-term liabilities. Meanwhile, the ROA and ROE for both companies, Pavilion comes on top, simply because they surpass both of those of Sunway, signaling efficient use of assets and better shareholder returns. While Sunway rates has merits, Pavilion rate stands out in our assessment. It is essential we factor in both data and broader market insights. Thanks for your hard work on this analysis. That concludes our meeting today, and thank you very much.
Thank you.